Hi, this is Alan Gassman. I'm here with Brandon Ketron and John Beck. You can't see John Beck, but he's here, believe me. And we're going to talk about charitable IRA and loan grant planning under the CARES Act. We've done a lot of reading over the weekend and this morning, and we think we've pulled it together pretty nicely for you. We're going to start off with Brandon's talk on loans and grants and tax credits. Then John's going to talk about some of the tax issues, and then we're going to go to IRA and charitable planning. Please join us tonight at 5:30. This is probably our most important talk, at least today, about insolvent businesses, because almost every business in the United States in certain industries is insolvent today, so you have to plan accordingly. Tomorrow at 12:30, we're going to talk about net operating losses, the interest deduction, leveraged real estate, and other planning. And then Wednesday, we're going to talk about what we haven't covered Monday and Tuesday. So we hope you'll join us for these. Brandon, I'm going to turn it over to you because I know time is precious.
Sure. So the first loan program I'm going to talk about is this Economic Injury Disaster Loan Program. This is an existing loan program that the Small Business Association already has, but what they've done under the CARES Act is really just change some of the requirements here for the eligibility of this loan. Typically, you have to be in a federally declared disaster area. You have to be in business for 1 year prior to the disaster. You can't obtain credit anywhere else. All those requirements have been waived. Now anybody in the country can get this loan. It's a max loan of up to $2 million. You have to be a small business with less than 500 employees and technically have to suffer substantial economic injury as a result of declared disaster. Now I think we can all pretty much say that we're going to suffer these economic injuries as a result of this. Things are closing down. Clients are not reaching out as much as they would have. It's going to be harder to meet with clients. So we're all having these issues and all having to deal with them. So as I mentioned here, there's no requirement that you have to be in business. You have no personal guarantees for the loans as long as it's less than $200,000. You don't have to pledge any collateral. You don't even have to really show an ability to pay. All it's done is based upon your credit score. No tax returns are required to be submitted. Now, as soon as you submit that application, you can request a $10,000 grant, which is just basically an advancement on your loan. And that's supposed to be paid out to you within 3 days of the submission of the application. Now, even if your application is denied, you don't have to pay back this $10,000. It's solely a grant, but the grant has to be used towards your employees, paying that sick leave, keeping your payroll cost, maybe meeting increased costs to obtain materials that are otherwise unavailable. So if you have to go to another supplier because your traditional supplier isn't necessarily providing those materials anymore, there's an increased cost, you can use that grant towards this. You can use it towards your rent and mortgage payments. And you can also, there's a catch-all category here that says repaying obligations that cannot be met due to revenue losses. So that's a pretty broad category of what you can spend this $10,000 on, unlike the next program we're going to talk about where you have to use it towards specific items. So the application for this one is actually available right now. The other program that we're going to talk about, the Payroll Protection Program, the application isn't out yet. We're not 100% sure how some of the details of that are going to work. But we'll walk through what we do know about that loan program. So as I mentioned, there is a new loan program through the Small Business Association. It's called the Payroll Protection Program. So who is eligible for this one? Well, it's all businesses with less than 500 employees. That includes independent contractors, sole proprietors, self-employed individuals. Everyone is eligible for this as long as you have less than 500 employees. It doesn't matter what income you have or the net worth of the owner. You simply have to make a good faith certification to the Small Business Association or the lender that the current economic conditions make the loan necessary to support ongoing operations. You're going to use these funds towards certain specific items, maintaining payroll, making mortgage payments, lease payments, or utility payments, and that you haven't already received a loan under this program. So when we're looking at the number of employees, it includes your full-time, part-time, or employees employed on another basis. So I'm assuming that means if you employed someone for an hour or two to do an odd-end job, they're going to be considered an employee for purposes of that 500 number if you're close. Now, for the food service industry, there's a special exception. Most food service industries, they have a lot of different physical locations. As long as each physical location does not have more than 500 employees, you're going to qualify as a small business. Now, for any other business, it doesn't matter the number of locations or the number of employees per location. It's just your total employees, regardless of that location. So a couple bit of the requirements of this loan. It's going to be a non-recourse loan, no personal guarantees required, no collateral required either. They're going to make it very easy to obtain these loans and not really go into a whole lot of background information on how, if this person has the ability to pay or not. They're going to generally be a pretty speedy process of granting these loans. You don't have to make certification that you cannot obtain credit anywhere else, which is typical for these types of loans, but under this program, you don't have to make that certification. So how much can we get? Well, you get up to the lesser of $10 million is the max, but generally the rule is going to be 2.5 times your average monthly payroll cost for the 1-year period before the date on the loan is made. So for example, if you get the loan on April 1st, you're going to look at your average monthly payroll cost from April 1, 2019 through April 1, 2020. Now, if you're a seasonal business, and we're not exactly sure what seasonal businesses are going to be defined as, there's not guidance on that yet. It says it'll be left up to the administrator to determine this. But if you are a seasonal business, you use a 12-week period, either from February 15th, 2019 through, the 12-week period beginning on February 15th, 2019, or you can elect to use March 1st through June 30th of 2019. So generally you would pick whichever one is greater if you're a seasonal business. Now, if you weren't in business from February 15th to June 30th in 2019, you can actually make these calculations based upon your payroll costs from January 1 through February 29th, 2020. So a couple of different requirements there as to when you actually calculate this payroll cost. So what are your payroll costs? Here we have the list: salary, wages, tips for the restaurant industry, your vacation, sick, family medical leave, all that's going to be included. Severance pay if you pay an employee on severance, healthcare benefits, including the premiums that you would pay for those benefits, any retirement contributions that you would make on behalf of employee are going to count, and any state and local tax assessed. Now, if you are a self-employed individual, and you may not necessarily be paying yourself an actual salary, you can take your net earnings from self-employment and deem that as a payroll cost. Now, the catch is that's going to be limited to $100,000 a year, prorated for the covered period. So it's not going to be exactly $100,000. Your payroll costs are going to be less than that, but you do get to take in those net earnings from self-employment up to $100,000 each year. What does it not include? Well, it does not include compensation in excess of an annual salary of $100,000. The taxes imposed or withheld for your Social Security, your Medicare, your income taxes that are withheld from wages, or any income taxes withheld under the Railroad Retirement Tax Act. So this is your net pay that you're paying to your employees that are included as your payroll costs. It's not the gross pay, but it's the net pay. It doesn't include any compensation paid to an employee outside of the United States, and it doesn't include any compensation where you've received a credit under the Families First Coronavirus Relief Act. Now, that act was the act that gave everyone a payroll tax credit for providing 14 days of paid sick leave and then an extended family medical leave related to the coronavirus. So if you receive a credit under that provision, you don't get to include that item as a payroll cost. So just to go through a quick example here, say we have 5 employees. 3 of them make $50,000 a year, and 2 of them make over $150,000 a year. So those 2 making over $150,000, you have to decrease their salary to $100,000. So that's $200,000 plus the $150,000 for the $350,000. So you have $350,000 of total annual cost. Divide that by 12 to get your average monthly cost, and then you multiply that by 2.5 times to get the max loan that you can receive under this program. So there's our limitations on what this loan can be used for, at least through February to June of this year. So it can only be used for payroll cost, continuation of group health care benefits, pay your salaries, commissions, which is your payroll cost, interest on any mortgage obligation, but not principal. So you can't get this loan and then immediately go and pay off a big portion of the principal of your mortgage. You can use it to pay for rent, utilities, and then again interest, but not principal on debt obligations that were incurred prior to February 15th. Now, the nice thing about this program, if you do receive this loan, there's a portion of it that can be forgivable, and it's based upon how you use the money. So if you use the money, you get an 8-week period to use this money. You can pay payroll costs, you can pay interest on mortgage obligations, rent obligations, and utility payments. If you use it for those circumstances, then whatever you've used during that 8-week period is forgiven. Now, if you terminate an employee or reduce an employee's salary by more than 25%, that amount that you could be forgiven is going to be reduced. So going over this, if you have 20 employees that were employed from February 15th to June 30th, 2019, and during the 8-week period you have those same 20 employees, then you don't have any reduction. But if you were to let go of one of those employees, so now you have 19 employees instead of 20, you're going to lose 5% of what could otherwise be forgiven. Now, there's a second layer of that. If you reduce someone's salary by 25% or more, the excess over that 25% is going to reduce the amount that can be forgiven. And we're not entirely sure how this is going to be calculated, because it's really comparing a whole quarter's worth of wages, because it's the first quarter that applies before the loan was taken out, compared to the wages paid during that 8-week period. So we're comparing 8 weeks to a quarter. The math doesn't really match up. So we'll need some additional guidance here on how this is going to be calculated, but I'm sure that's going to come out with the applications here in the next couple of days. And for purposes of the salary reduction section only, if you make over $100,000, you can disregard those employees. So any employee making over $100,000, if you reduce their salary, it's not going to affect this calculation. But someone making under $100,000, it is going to affect the calculation. Now, there is an exception that if you correct the termination of employees, so if you fire someone and then rehire someone to replace them, so you have the same number of employees, as long as you rehire them by June 30th, it's not going to reduce your loan forgiveness. Same thing applies if you reduce someone's salary. If you correct that reduction before June 30th, your loan forgiveness is not going to be affected. And then there's also the administrator of the Department of Labor and the Secretary of the Treasury can provide additional exceptions through regulations. We don't have those yet, so we're not sure what those are going to be. Here's just some information on the application. You have to file what's going to need to be included in that application when you're filing for loan forgiveness. So we have that information here for you available. The nice thing, too, is that this loan forgiveness, typically when you have debt canceled, it's considered income. They specifically excluded forgiveness under this section from income. So you don't have to worry about it being included back in income. You can still deduct the payments that you've made for salary, rent, utility payments, even though you're technically not coming out of pocket for those. You still get to deduct them, and then nothing's included in income. So it's a really nice provision here that provides some flexibility. Now, also as part of the CARES Act, they've done some different things.
Brandon, before we go forward, you're doing great. I've learned a lot, but I'm a little bit confused. So there's two kinds of loans. Can you just boil it down? Give us a summary of what you just said. There's two kinds of loans. What's the first kind of loan?
So the first loan is the economic injury disaster loan, where you can get up to $2 million. There are no certifications that you have to make. There's not a whole lot of limits on what you can use the money for, but you do have to pay that one back, with an exception of the $10,000, right, that you can get as a grant when you submit your application. As long as you use that $10,000 on those specific items that we listed in the PowerPoint, that doesn't have to be paid back. You get that no matter. Do you have to prove that you had any sort of economic injury, or you just get this loan? No, you can just get this loan. There is a certification that it says you have to suffer a substantial economic injury as a result of the disaster. That hasn't been defined yet as to what that is. There hasn't been guidance, but it seems that it's going to be pretty lenient based upon some of the things that I've been able to read about this economic injury, that most people that have, that at least live in a state where there's been a corona outbreak. Certainly here in Florida, where we have, Hillsborough County and Pinellas County are under safer at home orders. I think it's certain that you've suffered this substantial economic injury.
Okay, so have you looked at the application? Is it simple?
Yeah, so it's an online application. I was only able to get through a certain part of it without having to fill in actual information and submit the application. But basically, the application is you fill in the name of your business, you put in your EIN number, you give them your gross receipts for the 2019 year, and then your cost of goods sold for the 2019 year, and then you have to check the boxes as to why you qualify for the loan, that you are a small business with less than 500 employees. There's certain other questions that you've asked, that's such as you aren't under any criminal investigations, you don't have any outstanding taxes owed, certain certifications such as that on the application. But for the most part, it seems like it'd be 5-10 minutes max to fill out this application online, fairly simple, and then submit it.
You give them an amount? You give them an amount you're requesting?
So I didn't get to that part of it, at least. I wasn't able to click far enough ahead without actually submitting, information to the secretary, that would start processing this application. So I'm not sure if you request the amount or they come back to you with the amount that you can get, but you can certainly get up to that $10,000 immediately.
Okay, well, you can sit with our office manager, Kim Copeland. You can fill out the application for our law firm, and then tomorrow at 12:30, you can tell people what the entire application is.
Perfect.
Is there any reason not to do this application? Does it interfere with the second loan, which is for the payroll expenses?
No, so this one actually doesn't interfere with the payroll protection loan. Now, if you get some of the payroll protection loans, you're not able to receive some of the employment tax credits. But I think these two loans are independent of each other, that you can get both of them if you qualify.
Okay, now the payroll protection program you can use to pay your normal payroll, not any salary to the extent exceeding $100,000. Do you have to prove that you lost money from the virus or the economic situation, or no? It's just
there's no proof.
Uncle Sam's going to pay for everybody's payroll.
Right. You have to make this good faith certification that the uncertainty of the current economic conditions make the loan necessary to support ongoing operations. It's the only thing you have to certify. You're not required to submit any proof of that. It's the secretary has to take your word for it if you make this certification, and you're eligible for the loan.
Okay. Well, that's pretty amazing. So a lot of people are going to rehire their employees on the basis of reliance upon being able to definitely get this loan. How sure are we that the government's going to come through and actually give everyone this loan if they've kept everyone on the payroll? It sounds pretty scary to me.
I think that's the question, is there's a limited amount of dollars allocated to these loan programs. So we're not sure if it's going to be on a first come, first serve basis, if it's going to be on sort of need base, based upon the applications that are submitted. But certainly I think you would want to get your application in sooner rather than later, because eventually this money is going to run out and there's not going to be any money left to allocate these loans or forgive these loans once that money is gone that the Congress has allocated towards these programs.
Now, the payroll protection program loans, the application's not out yet, the regulations aren't out yet. And isn't this the one that banks are going to administer? Banks are probably going to administer this one?
Yeah, so any bank that's eligible to give away small business loans are eligible to administer these types of loans. So it'll be,
okay.
I would say most vendors are going to be available to issue these loans.
All right, very good. What's next?
Okay, so next is part of the CARES Act here. They gave you a credit on your employment taxes for basically retaining employees. You get a tax credit for up to 50% of the wages that you've paid from March 12th, 2020 through January 1, 2021, as long as you fall within some certain requirements during that time period. It's limited to $10,000.
This is a credit. This is a credit against the wages, or just a credit against the wage tax?
It's a credit against the wage tax, but you get the credit on the full amount, on 50% of the wages paid. So if you pay someone $10,000 per employee per quarter, $10,000, you get a credit for $5,000 against your employment taxes.
Unbelievable. That's a really big amount.
Yeah. So you get this reduced by any credit you received under the Family First Coronavirus Act, which gives you the credit if you pay towards sick leave and family medical leave. But here's the catch, is that you have to be either fully or partially suspended due to orders from a government. So it's not just anyone that qualifies for this, or you have to have gross receipts that are 50% of the gross receipts of the same quarter in the previous year. So say you take the second quarter of this year compared to the second quarter of last year. If your receipts in 2020 are 50% less than that amount, you're eligible for this credit, or if you've been fully or partially suspended due to a government order. And you're not eligible for this credit if you get a loan under the Payroll Protection Program. So there's a little more requirements to get this employment tax credit than it is just to receive the loan. Plus, you're only getting credit for half of the wages and not the full amount of wages that you would get credit for under the loan program. So it seems like the loan program is going to be better than this payroll tax credit, given that you can actually get the loan. If you don't get the loan, then you can fall back on this if you're in one of these categories. As another part to help with cash flow of businesses, they've allowed you to defer the 6.2% Social Security payroll tax that is typically withheld from employees' wages. It's the employer's share of that tax. And if you defer it, you pay 50% by December 31st of 2021, and the remaining 50% by December 31st of 2022. It doesn't apply to the employee share of the tax, doesn't apply to the Medicare tax. It only applies to that 6.2% Social Security tax that's withheld by the employer.
Okay.
All right, and now I'm going to turn it over to John here and let him talk a little bit about what else they provided under the Act.
Thanks, Brandon.
All right.
Hey, John.
Hi, how are you? So on slide 20, everyone pretty much knows this rule already. Taxpayers are receiving about a $1,200 check depending on their income. We have the threshold here. The one thing I'd like to point out is that just exceeding the threshold doesn't mean you won't receive any benefits. It's just reduced by $5 for every $100 of income you have in excess of the thresholds listed on the slide. So the Act does also provide for some additional unemployment benefits. In order to receive additional unemployment benefits, the taxpayer must be a covered individual. And that's a very broad definition under this Act. Almost anyone who is negatively affected and can't work due to a quarantine, or anyone who has the virus and can't work can benefit for any week that they're unemployed. So under this plan, the unemployed individual can receive an extra $600 for every week of unemployment. So this was somewhat controversial because some people will receive more money by being unemployed than they would by actually being employed. The taxpayer can receive these benefits for up to 39 weeks, and it was actually made retroactive. So anyone who was affected by the coronavirus and is unemployed between January 27 and December 31st of this year can benefit. So some individuals will not qualify, and the one that I'd like to point out from this slide are those individuals who are unemployed before July 1st, 2019 and exhausted their state benefits. They will not be able to extend benefits under this plan. So for the retroactive portion, we don't really know what the procedure will be in order to apply for those benefits. So once guidance is put out, those individuals who are employed should be able to navigate their way through this. The Act also provides unemployment benefits for self-employed individuals. So these individuals have to qualify under similar circumstances where they could not get to work due to a quarantine or have the virus and can't work. But that doesn't mean that those individuals will also qualify for state unemployment. It's just for that $600 a week benefit. The state unemployment benefits are unmodified in that circumstance. So emergency unemployment relief, one of the benefits here is that certain governmental organizations and nonprofit organizations don't need to pay into the unemployment fund. So that's going to be a huge benefit for certain nonprofit organizations, and that those funds will instead be paid through the money appropriated under this act. And the states, even though they'll have added burden because the states will be the ones actually paying this extra $600 and managing the applications, the federal government isn't only going to reimburse that $600 per week benefit. The federal government will also reimburse the administrative costs associated with this increased burden on the states. And there's been a lot of talk about potential fraud. The Act does provide a provision to combat fraud and provides the government with a method to try to enforce any of those type of situations. Another benefit is now unemployment will be available in the first week of unemployment. So this state will have to agree to provide benefits in the first week of unemployment in order to get reimbursed for that. So as we mentioned earlier, this will be retroactive back to into January, but just some added requirements. Just like with regular unemployment, the individual applying must be ready and willing to work and actively seeking employment in order to qualify. Now moving on to retirement accounts, there are some added benefits and flexibility for individuals who are affected by the coronavirus. Individuals can take a distribution of up to $100,000 from the retirement account as long as they're affected by one of these circumstances. So there's 5 total. The first 4 deal with ability to work, having your hours reduced or being laid off. And the second one is just being diagnosed with the coronavirus. So some individuals may be able to still work from home and receive their full benefits, their full compensation amount, but if they're diagnosed, they could withdraw up to $100,000 from their IRA plan, and the only thing that needs to be provided is a self-certification from the plan participant to the plan. And when you take that $100,000 distribution, you will not be subject to the 10% penalty as long as you qualify. There are a number of exceptions to that 10% penalty under Section 72T, and this just adds another exception to that. But you do have to remember that you need to pay income tax on the amount withdrawn. So taxpayers need to plan on whether it's worth taking out this $100,000. If you take out $100,000 or less, you'll have the income tax consequences, but you may have lower income in 2020. If you leave the funds in the IRA, sure, they could grow tax-free, but it would be ordinary income. If you take it out, you might be able to convert some of that to capital gains.
John, you have 3 years to pay it back, right? And then it's not considered to be a distribution. So for a lot of people, if they're disciplined, they'll take out the 100, and then they'll wait 3 years, see how the investments in the 100 do. If the investments in the 100 do great, they'll leave it out, be better off. If the investments don't do so well, then they'll repay it in the 3rd year and then get a refund for the tax they paid for the 2020 distribution.
Right.
So there's going to be a lot of game. There's going to be a lot of game playing with this. At first, I was thinking no one should touch this because it's creditor proof and it's more advantage. But now I'm thinking if the regulations come out before the end of this year and they allow you to make that choice at the end of year 3, then everyone who can, even if you missed 1 hour of work, you should take out the 100, put it in a mutual fund, see how it performs, and then decide whether to put it back at the end of year 3, right?
Right. As long as you don't have a huge creditor issue, it would be a good idea to take it out. And the way that 3-year period works is it treats the recontribution as basically a 60-day rollover to another plan.
And you can elect to pay tax for 2020 on the whole withdrawal, or a third in 2020, a third in 2021, a third in 2022, or put it back in and amend 2020 and 2021, I assume. I think they'll be coming out with regulations to explain this.
Yep. The Act also allows for added borrowing from your retirement fund. So they increased the limit from $50,000 to $100,000, and you don't have to make payments in the year 2020. So that adds a little bit more benefit, but it also increases the amount available for the loan. So you can see on this slide, paragraph B, you can now take a loan out in relation to the present value of all of the non-forfeitable accrued benefit rather than just half of it. So that's going to be...
There's an error on this slide. It should be borrowing from pension plans. You can't borrow from an IRA. So the borrowing is only against a pension plan. So we'll correct that slide for future use.
Another benefit is a waiver of required minimum distributions for 2020. Now this will help people who turned 70 and a half in 2019 and would have to make their distribution, their first required minimum distribution, by April 1st of this year. So those individuals who have not already made that distribution can now hold off for another year before having to make a distribution from their IRA. And essentially, there will be no individuals who need to make a required minimum distribution this year because the Secure Act extended the first age of a required minimum distribution to age 72. And then this also extends the 5-year rule for inherited IRAs for individuals who do not otherwise qualify, for example, a lifetime stretch. From the 5-year rule, it now becomes a 6-year rule. So anyone who received an interest between 2015 and now would have a 6-year rule apply. And here's just some information on the change from 70 and a half to 72. And also we'd like to point out qualified charitable distributions from an IRA. This plan, this act, does not modify this. You still have that $100,000 qualified distribution allowance, but if you make contributions to your IRA after 70 and a half, that will decrease your qualified charitable distribution amount. Now, for example, if you donated, if you contributed money to your plan after 70 and a half, let's say you contributed $6,500, and then you did a QCD of $80,000, you would have to reduce that QCD by $6,500, but in the following year, you'd have that full $100,000 available. So the Act does modify the application of Section 170. This is for your charitable deductions. And if you look on this slide, this is language from the Act itself. A qualified charitable contribution has to be made in cash. And then when it talks about the entities that qualify, basically it will allow you to take, it'll allow any donation to charity that's not a private foundation, a supporting organization, or a donor-advised fund. So the
wait. Those were You mean it'll allow up to 100% of adjusted gross income to be deductible in 2020 if made to any organization other than a private foundation, a supporting organization, or donor advised fund? What about a private operating foundation?
Private operating foundation is considered a public charity for this purpose. So you can take 100%.
And then is it 100% of appreciated assets or just cash?
Has to be cash.
Okay.
So this slide is just defining qualified charitable contributions. So any modification only applies to cash donations made to a public charity, private operating foundation. It doesn't count for supporting organizations, donor advised funds, and private foundations. So if you have a qualified charitable contribution and you don't itemize, you can deduct up to $300 above the line. So those individuals who take the standard deduction, they make $300 donations to charity throughout the year, that can be deductible. And this is what we talked about with the AGI increase. Donors can now contribute up to 100% of their AGI to charity in 2020, but this does not apply to the carry forward. So if you contribute more than 100% of your AGI in 2020, next year you'll be subject to normal limitations, which is 60% cash to a public charity, 50% for appreciated assets, etc. And that change, as you would assume, is not permanent, but the change on the last slide is supposed to be permanent, so that $300 above the line deduction should apply going forward.
And that $300 can go to any kind of charity, I would think?
That also has to be a qualified charitable donation, so that can go to any public charity or private operating foundation.
Okay. How about a donor advised fund?
Can't go to a donor advised fund for this.
Okay. All right. Well, we did pretty well here. We promised in 30 minutes. We gave you 37 minutes. Hats off to John and Brandon. We worked hard on the outline yesterday. Check out tonight's interview with Mike Markham at 5:30. It went about 40 minutes. We spliced it and diced it a little bit. I think you'll find it to be very, very valuable and also quite entertaining. If you know Mike Markham, you can enjoy any conversation you ever have with him. Tomorrow, we're going to know and tell you all about net operating losses, the interest deduction, and really, most importantly, leveraged real estate, whether to turn partnership entities and disregarded entities into S corporations, so that if and when you have income from discharge of indebtedness, you won't necessarily have income tax under Section 108. We're going to talk about some other practical planning issues relating to that tomorrow. Then on Wednesday, we're going to talk about everything else that we haven't mentioned under the CARES Act and what's going on. We're going to talk about force majeure clauses. We're going to talk about the doctrine of impossibility, the doctrine of impracticality. Even if you have a contract that doesn't have an act of God force majeure clause, it may not be enforceable because of the other provisions which are recognized under Florida law and the laws of most states. And we're going to talk a little bit about the 80-hour employment credit, where employees affected can get paid up to 80 hours, and the government pays for that, or to take care of children up to 10 weeks, the government pays for that. We're going to mention that. We're going to mention special exceptions that apply for medical practices under these labor laws, which just came out yesterday. We're working with Colleen Flynn over at Johnson Pope, and we'll have her opinion on that by Wednesday. So please stay tuned. Finally, we welcome your questions, comments, and suggestions. We learn a lot from questions that were asked. You've got our email addresses here. Thanks again to John Beck and Brandon Ketron. Thanks for attending. May the rest of your day be billable. Thank you.